Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly review for the week ending April 28, 2023. Let's start with a look at this week's markets after 4 days on Thursday. So as much red as black on the week. Higher rates in Canada, negative for bonds, neutral for corps. TSX underperformed a little bit this week, along with EFI in emerging markets. S&P 500 looking for a direction, but still positive because of the effect of the weakening of the Canadian dollar, which was, because of the price of oil, which even though we had an OPEC Plus cut in production a few weeks ago, we remain range bound between about $65 and $80, somewhere around this level. So OPEC Plus cut because they're expecting weaker demand ahead. So the market is not necessarily seeing that as a catalyst. So we're still pretty much in that range. Still at the price of gold slightly higher on the week. So this week I'll talk again about the Bank of Canada, about economic data, and about inflation. I have to, because this is what matters, and these are the data that are coming out. But Bank of Canada remaining on the fence. At the beginning of this month, we had the latest decision from the BOC. They decided to stay put, but Governor McClem was very clear in a press conference saying that they spent as much time debating a rate hike as much as staying in a pause. So they're not thinking about cutting, they're thinking about maybe raising rates again. So it's a very important message, one that we think is a significant risk for 2023, that we have one more hike at least from the Bank of Canada. Significant, it's not our base case scenario. The market is not pricing in a rate hike now, it's not pricing cuts that much either, but there is a risk because inflation remains stubbornly high. So we need to consider that when we look at the assessment for the rest of the year, and we do that in our strategy, of course. Now, going to the US, weaker GDP growth in Q1, but the volatility of inventories is kind of muddying the picture here. So last quarter, when I looked at the GDP figures, I was saying that, well, the GDP is stronger than expected, but it's mostly because of inventories, because it's gross domestic product. It's what's being produced that is accounted here. And if you produce something, you don't sell it, you put it on the shelf, it goes into GDP, but no one bought it, so it didn't really create, economic activity on the demand side. It was just a supply side item. And if the quarter or quarters later, you see people buying what's on the inventories, then it's going to be subtracted from GDP because it was on the shelf, it wasn't produced. So it's technical, but it does create some volatility in economic figures. And on the right, you have the contribution of inventories. You see it was pretty strong here. So if, let's say, we average the last two quarters, Q4 2022 and Q1 2023, we have an economy that is steadily slowing down as we expected because of the hiking of monetary policy, of the leading rates, so the tightening of monetary policy that was very important in 2022 and continues in the US in 2023. As a matter of fact, next week there's a Fed decision and it's telegraphed. Everyone knows that the Fed is going to be hiking by 25 basis points. Everyone wondering if that will be the last hike before a pause or will they continue. This is debatable, but a slowing economic environment is the base case scenario. And this is not just our base case scenario. When you look at the consensus forecast here from Bloomberg, on the left you have 2023, on the right you have 2024. So those are lines that move because we track the consensus as it moves through time. So forecasters can be optimistic, then become less optimistic and go back to optimism, just like what we seem to see for 2023 here. But still, if you look at the numbers, you see that we're really facing a slow growth environment. Red is Canada, dark blue is the US, gray is the Eurozone, the lighter shade of blue in the middle is the world, and on top of the chart is China. So as you can see, global growth of about 2.5% over the next 2 years. Just remember, and I've mentioned that in the past, that the generally agreed upon threshold of global recession is 2.5% growth for global GDP. So global GDP contracting, it's very rare we see that. We've seen that in 2008, but before 1980, we don't have good data. since 1980, 1 year, 2008, that's it. So 2.5%. So we're kind of more like flirting with a recession here. Canada, US, Eurozone growth of about 0 to 1% for the next 2 years. That's very slow. So of course that's going to be impacting earnings growth and sales growth. Thus, us being more careful with equity risk right now. And China outperforming again, but emerging markets should do better than developed markets. That's kind of the message here. So this is an environment of slow growth, and you need to take that into account in your portfolio positioning. So as I mentioned last week, we are slightly defensive, but again, good times, bad times when you do asset allocation, there is always opportunities. So if economic growth is strong, then you want more equities, less fixed income. And if it's the reverse, and just like right now, interest rates are high, there's a potential for capital gains on bonds. If we do have a slowdown that materializes, an economic shock, then you want more bonds. So this is our job, to expose the portfolios to the right risks at the right time. And as I mentioned last week, when I mentioned 2-3% overweight, underweight, this is the current situation now. So we're not panicking, but we are rather defensive. But this is for a balanced profile, but more conservative to more aggressive profiles, the over underweight will depend, and also depend on our views if at some point we think, all right, it's time to become much more defensive because the economic slowdown is getting closer or more real, is getting worse than expected, then of course we'll have bigger deviations from neutral policies at these times. So just to give you a big picture of how we integrate all of that. So a negative outlook doesn't mean that we're loaded with cash and we don't see opportunities anywhere. I mean, we see ample opportunities, but they're more fixed income now than in equities. I refer to last week's video if you want to hear more and you haven't seen it. Households in the US are worried about the future, and it's very interesting to see these two indicators together. You have the gray line, which is the yield curve in the US, and everyone uses the yield curve and knows that the yield curve is a leading indicator of economic recessions, also of bear markets often. These tend to go hand in hand. And the blue line is the confidence differential. So the Conference Board Consumer Confidence Index, they ask multiple questions, and they ask, what's your assessment of the current situation and what's your assessment of the future? And if you do future minus current, you get an idea of how people are optimistic or pessimistic about things to come. And this is exactly the line that's there, and see how it correlates strongly with the yield curve. So the real economy, households picking up the phone, answering questions, tends to correlate very well with the signal that is given by the yield curve. So you have financial markets seeing risks of a recession ahead, and also households, because as you see, the gray shaded areas here are recessions. And usually when you have negative levels like this, this is a telling sign that there's a recession coming. So leading indicator that's interesting that's important to consider. And all of the signs that we're looking at tend to agree that we're headed for tougher times. So one more to, of course, give credence to. Maybe finally, the PCE inflation measure in the US, just this is the measure that's favored by the Fed. And if we look here at the last 3 months annualized, so let's say the recent pace of inflation, total and core, we're at 4 to 5%. This morning, this came out. It was pretty much in line with expectations, but still, the message coming from these figures here is that inflation is still sending signals to the Fed that it's appropriate to continue tightening, or at least they're not yet at the point where it's time to start to cut. So this is the message here. So I won't, spend too much time on that, because we covered that weekly, it seems. All right, so next week, what to watch: S&P Global Manufacturing PMI, and we'll have the jobs report. Last month we added 35,000 jobs in Canada. Let's see the pace this month for April. In the US, ISM Manufacturing and Services indices a bit higher than last month, but not so much. Fed rate decision, a hike of 25 basis points is expected, and the jobs report, 180,000 jobs are expected to be added to the US in April. So that wraps it up. ia.ca/economy. You'll find everything you need there. in your interest podcast, always new material, so please give it a look. Economy and Finance 101, good news, new material is coming. Adil Maroug, who works with me now, will be taking the helm on that. Lots of material coming, so more for you. And social media, of course, you can follow us there regularly. So thank you for your trust, and I'll see you again next week.